Hello. Good morning, good afternoon, good evening, depending on where you are and when you're listening. Welcome to tonight's 15 Minutes of Fire. I'm Bernadette L. Harris. I'm the CEO of the BTB Advisory Firm, and we are a firm where we work with small business owners who are committed and ready to grow their businesses. So, our 15 Minutes of Fire is a quick session that I do just to educate small business owners. One of the things that I've realized in the 21 years that I have been in business is that small businesses don't go out of business because they don't know how to do what they do. They go out of business because they don't know how to run a business. And so these sessions are intended to educate business owners so that they can avoid some of the mistakes that lots of business owners make and be successful in their businesses. So tonight we are going to talk about some highly abused or misused tax deductions. Um, like I said, I've been in business for 21 years and I have seen a lot. I have done thousands of tax returns. I've worked with thousands of entrepreneurs, and I've seen a lot of bad stuff happen. Let's say that. So one of the things that I found is that the business owners getting that are using deductions that I think I call them the highly audited deductions are typically business owners who are doing their own taxes or they're doing their own books. So let's talk about some of these misused or highly abused deductions. Most of the times when I see deductions that I think are going to cause an issue is usually because the person does not keep good records. They are estimating or guesstimating, whatever you want to say, when it comes to their numbers. And I usually notice because they're round numbers, right? And so when you spend exactly $2,000 on office supplies or things like that, those are usually telltale signs that you don't have a record keeping system. You're just kind of guessing how much you're spending. And that is a red flag. That is something that could get you audited. So let's talk about some of the misused deductions. The first one that I want to talk about is meals and entertainment. This one is a deduction that I see a lot. The first thing that I want to say is with the recent tax law changes, entertainment is out the window. So entertainment is no longer deductible. So if you're taking your clients to basketball games or to the opera, things like that, those things aren't deductible anymore. The tax law changed in 2017 and took away the entertainment part of meals and entertainment. That's number one. Number two, meals is a highly abused deduction because a lot of times business owners think, oh, I'm working, I'm hungry, I eat, so now it's deductible. It doesn't work like that. Solo meals are only deductible when you are traveling. So if you are traveling for a speaking engagement, for a conference, you're out of town for work, and you get lunch, that's deductible. If you're working from your home office or you're working from your office, if you have like a office outside of your home and you just order lunch because you're hungry, that's not necessarily deductible, right? So it has to have a business purpose. So one, you're traveling for business, so that will make the meal deductible, or you are meeting someone for business. So let's say you go and you have lunch with a potential client or a potential referral source or a potential colleague. Oh, no, not a potential. I mean, if they're a colleague, they're a colleague, but a colleague. And you have lunch with this person, you all have a business conversation. Usually it's best if these lunches or dinners were planned in advance and it wasn't just you ran into each other at the mall and you say, hey, let's go grab lunch and talk business. It's usually pre-planned. So pre-planned, you would have like an email or a text message to say, hey, let's meet for dinner on Friday at 7 or something like that, right? And there is a business purpose for you meeting. So that business purpose could be, again, if it's a potential client, it could be so that you can woo them into becoming a client. It could be that you are meeting with a referral source and you want to let them know what you do and how you do it, and maybe they can send you some new business. And so that may be an example of why of a business meeting. So again, it needs to have a business purpose. So now let's say, for instance, if you have an office and you have employees, excuse me, and you decide to order lunch for the whole office, that's a little different than you just ordering yourself something. So those, make sure that your meals all have business purposes. Um, a lot of business owners, and I've seen it, like they're eating out every single day and writing it off on the business. Not good. Number one, it's not good for your health, and number two, it's not really a good business practice, because I did a video where I talked about writing everything off is not a good idea. And so just spending money or deductions or whatever for the sake of spending money is not a good business practice. If you are having a business meal, make it a business meal that is going to generate income for your business. Okay, I talked about that longer than I intended to. Another misused deduction is mileage. Mileage is a great deduction, and I have another video about using your vehicle and how mileage works. So you can check that video out. But mileage is a great deduction. You just need to keep records. So there are mileage apps that you can use and download to keep track of the miles that you drive in your business. And it will allow you to get a great deduction in your business. The abuse comes because people are lazy and they don't track their miles. And so they tell their accountant, I drove 15,000 miles. And it's like 15,000 exactly, like not 1501. I mean, don't tell us 1501, but the point is, make sure that you're tracking your miles so you have an exact number of miles. I've seen a lot of abuse with that. I can remember during the pandemic, there was a business owner who claimed to have driven 15,000 miles during the pandemic. And it was like the first year of the pandemic, we were all stuck at home. Like, how did you drive 15,000 miles when nothing was open and there was nothing to do, And the business owner wasn't like a truck driver or something like that. So it just wasn't plausible to have driven that many miles. And so that is also something to think about. Like, is it really realistic to say that you've driven 15,000 miles? Now, if you're a realtor and you're showing people houses, that may be realistic. You live in a city where everything is spread out, it may be realistic, but you want to keep that in mind. Another deduction that I've seen people misuse is uniforms, right? And so a lot of times people think that, oh, I bought this suit for this speaking engagement, or I bought these clothes for this photo shoot, so now they are deductible business expenses. No. A uniform is deductible, but regular clothes is not deductible. And so I speak all the time. And so if I buy a new suit or a new dress or a jumper or whatever for a speaking engagement, I'm not deducting that. I do photo shoots all the time, and I'm in 5 or 6 different outfits. Those outfits are not deductible just because, and a lot of times I buy them just for the photo shoot, but it's not deductible just because you bought it for a photo shoot. Regular clothes is not considered a uniform. The only way something would be a uniform is if it had like your logo on it. So you may have seen some of my other videos where I have a t-shirt and I have my business logo on it. That shirt is deductible. Those shirts were paid for by the business because they have my business logo on it. Because it's my business, I will wear that shirt any and everywhere. But just think about, like, if you had a job. When I was in high school, I had a job at McDonald's. When I was working at McDonald's, I was not trying to wear my McDonald's uniform anywhere besides McDonald's, right? And so that is usually a sign of a uniform, meaning that you wouldn't wear it somewhere else. Ordinary wear is not deductible. And so you cannot deduct your clothes, even though those clothes are for your business. There are some exceptions for entertainers, but again, if you're not like an entertainer, that's something. Another deduction that I've seen, or a misused expense, is dry cleaning. Again, because they have these suits and you have your suits and you need your suits, you're a lawyer, you need your suits to wear them to court or whatever the case may be. A lot of times I've seen people want to deduct the cost of the dry cleaning for their suits. If it is not a uniform, the dry cleaning is not deductible. The only exception for when dry cleaning is deductible is if you get your clothes dry cleaned while you are traveling. So let's say, for instance, if you're traveling, you go to a conference, you don't want to take dirty clothes back. You know how the hotel has those little bags where you can put your dirty clothes in and they'll launder your clothes and bring them back. In that example, your dry cleaning or your clothes cleaning is deductible. However, if you're just home and taking your stuff to the dry cleaners around the corner from your house, not deductible. And so those expenses are not deductible. One of the keys to making sure that you are not on the audit list, right? You're not one of those business owners who gets a nice little love letter from the IRS is making sure that you partner with a reputable accountant, whether it's me or someone else who knows the tax code, right? And understands the things that you can and cannot deduct. And then also making sure that you have a record keeping system in place to keep track of those deductions. So I know that there are people who just stretch the tax code, and you have to ask yourself, is it worth it, right? Because if you are audited, do you even have the records to sustain the audit? Like, do you have the records? Like, getting audited is not the worst thing. Getting audited and not having the records to back up what you claimed on your tax return is actually what's worse. If you have records and you're legitimately claiming deductions and you can back it up, that's really good. I had a client once who got audited, and it was really silly. Like, the IRS just audited one expense line on the tax return, and they were like, "Hey, we just need proof of this particular expense line," and it was an easy audit because we had accounting system in place. Was able to just go to the accounting system, print out all the transactions. All the transactions had the detail of what the expense was for, send it over to the IRS, and they said, "Thank you very much," and it went away. And so, again, the key is to make sure that you have a record keeping system in place so that if you are ever audited, you can make it out alive, right? So thank you so much for watching our 15 Minutes of Fire tonight. And I will see you the next time. Have a good one.